Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. Last week, we established a foundational principle. Real estate investing is a language, and you must be fluent to succeed. But a language is useless without a structured way to apply it. That's why we have the Prime framework: prepare, research, invest, manage, and expand. Today, we're taking the 10 most essential investing terms and plugging them directly into that framework. This is where theory meets action. My point of view is this: knowing the definition of a term is entry level. Knowing where it fits in your process is what makes you a professional. We're going to walk through the research and invest phases of Prime, and I'll show you exactly which terms are your primary tools at each stage. This is the sequence, the playbook for how a deal actually comes together. Let's get started. The research phase is where the battle is won or lost long before you ever make an offer. It's about filtering the vast universe of properties down to a single viable target. This process is driven by 5 key terms used in a specific order. First, you apply the deal evaluation trio to every potential property that crosses your desk. This is your high-speed filter to avoid wasting time on deals that will never work. Term number 1, net operating income, NOI. Think of this as the property's vital sign, its heartbeat. Before you worry about loans or your personal profit, you must answer one question. Is this property a healthy, profitable business on its own? The NOI gives you that pure number. My rule is simple. If the NOI is negative, I don't even open the spreadsheet for the rest of the numbers. The conversation is over. A property that can't pay its own bills is a liability, not an asset. Term number 2, capitalization rate, cap rate. Once a property has a healthy heartbeat, you ask, is it priced fairly for this market? The cap rate is the great equalizer. By dividing the NOI by the purchase price, you can compare a $500,000 duplex to a $1 million fourplex on an apples-to-apples basis. A property with a $50,000 NOI selling for $1 million is a 5 cap. A property with the same $50,000 NOI selling for $800,000 is a 6.25 cap. It tells you the raw earning power of the asset, allowing you to see which property offers a better return for its price, independent of financing. Term number 3, cash-on-cash return, COC. If the cap rate looks solid, you finally make it personal. Is this deal good for me? Your COC return is your personal report card. It tells you the return on the actual cash you have to pull out of your pocket, your down payment, your closing costs, your renovation budget. This is the number that tells you if an investment will help you reach your financial freedom number. It's the final gatekeeper in your initial analysis. After you've used this trio to find a property that works on paper, you move to the second layer of research, crafting the business plan. This is where you use the value-add metrics. Term number 4, after repair value ARV. Here you define your vision. The ARV is the North Star of your project. You're not just buying a property, you're buying its potential. You ask, what could this property be worth after I execute my plan to improve it? This isn't a guess. It's a calculated number based on what similar beautifully renovated homes in the area have recently sold for. Term number 5, equity. This is the treasure you're creating. In a value-add deal, you don't wait for the market to give you equity. You force it. The gap between your all-in cost, purchase plus rehab, and the ARV is the wealth you are manufacturing. It's the tangible result of your vision and hard work. By the end of the research phase, you've used these 5 terms to find a deal, validate its numbers, and create a clear plan to add value. Now, and only now, are you ready to move into the next phase. Welcome to the invest phase. Your research is done, the numbers work, and the plan is set. This phase is all about execution. Securing the funding and negotiating the deal. This requires a different set of tools. First, you must secure your capital. This is where you speak the lender's language using the financing foundation trio. Think of this as your pitch to the bank. Term number 6, loan to value, LTV. This is the lender's first line of defense. It's the loan amount versus the property's value. From their perspective, a lower LTV means you have more skin in the game and their investment is better protected if things go wrong. Term number 7, debt to income. DTY. Next, the lender looks at you. Your personal DTI is their way of asking, are you financially responsible or are you overstretched? A low DTI proves you have the financial breathing room to handle your obligations, making you a much safer bet. Term number 8, debt service coverage ratio, DSCR. Finally, the lender puts the property itself under the microscope. The DSCR is the ultimate test. It proves the property's NOI can comfortably cover the mortgage payment. A lender sees a strong DSCR, typically 1.25 or higher, and thinks, great, this property can pay me back without the investor needing to dip into their personal savings. Once your financing is lined up, you move to the negotiating table. This is where you use your negotiator's levers to protect yourself and enhance your returns. Term number 9, contingencies. These are your legal eject buttons. They are your non-negotiable safety nets. An inspection contingency protects you from a cracked foundation. A financing contingency protects you if your loan falls through. I've seen investors lose their entire earnest money deposit because they waived this and couldn't get a loan. My point of view is absolute. A deal without contingencies isn't a deal. It's a gamble. Don't gamble with your capital. Term number 10, seller concessions. This is your opportunity to sweeten the deal for yourself. A concession is anything the seller agrees to pay for, like your closing costs or a credit for a needed repair. Every dollar you get in concessions is a dollar you don't have to bring to closing, which directly boosts your cash-on-cash return. It's a powerful tool for optimizing your investment from day one. And that's the roadmap. The Prime framework gives you the stages, and these 10 terms are the critical tools you use to navigate them. You start in the research phase, filtering with NOI, cap rate, and COC, then building your vision with ARV and equity. Then you move to the invest phase, securing your loan by speaking the language of LTV, DTI, and DSCR, and closing the deal by using your contingencies and concessions. It's a logical, repeatable process. Master this flow, and you move from being a confused beginner to a confident, systematic investor. Now your challenge today. Put the framework into action. Find one active rental property listing. Your challenge is to take it through the first part of the research phase. First, run the deal evaluation trio to see if it's even worth a deeper look. Calculate a rough NOI, estimate a cap rate, project a potential cash-on-cash return. Decide, based on your hunt, does this property even deserve to move on to the next step? Now that you have the complete investor's roadmap, our final episode will introduce you to a powerful new tool designed to help you master these stages and accelerate your learning curve, ensuring you're prepared and confident for your first or next deal. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.